Hey everyone, thanks for tuning in. This is David, the mortgage broker. Today's class is going to be on Calyx Point and how to pre-approve someone. Loan officers, tune in. My information is below. If you have any questions or scenarios that you'd like to go through together, talk to you soon. Okay, everyone, we are in the Calyx Point system. When you log in, this is the first thing you're going to see. So the first thing we want to do is make sure you are in your prospect section here on the left side, so that way when you search and work on your pre-approvals, you have all of your borrowers' data here. When they become an escrow or a live loan, as people refer to it, you could go ahead and transfer them from prospect to borrower, which is here on the right side. On the top right, you're going to go to new blank file, and we're going to see our basic 1003 information. What you want to focus on as a loan officer is going to be loan application 1, page 1, 2, 3, 4, 5, 7, and 8, and finally 9. So why is that important? Because it's going to give you the meat and potatoes of the loan. It's going to tell you it's going to give you ratios, debt to income ratios, and your LTV, which will make a decision on what type of product you're going to go with and if the borrower qualifies or not. So first things first, before you go to the prospect information, I'd like to start in the loan application section first, because this is going to be your borrower information. Once all of your borrower information is submitted and your credit is pulled, then you go back to the prospect information, because that's your page that would give you your ratios. And that's where you can play around with a purchase price, mortgage insurance, homeowners insurance, property taxes, and such. So you're going to go to 1A, personal information, fill out first name, middle name, last name. We're going to create a fake a test file here. John Doe, okay, Social Security, okay, date of birth, okay, and we're going to fill out the citizenship. Moving on, we're going to always put a cell phone number and then an email address as well. If there is a spouse, we want to put that information here on the right side. In California, a spouse is someone who's legally married to the borrower. If you're going with an FHA loan, you always have to run the spouse's credit report, regardless if they're going on the loan or not. So as a heads up, you want to put that information, get it from the tax returns and put it on in there if that's the case. And if it's just one borrower, not married, then you go ahead and put their information only. Move on. Marital status, you keep moving. If there's another, this question is important. If unmarried is a person who is not your legal spouse, but who currently has a real properties right similar to those of a legal spouse, why is this important? Because in the state, sometimes if you're married to someone for more than 5 or 10 years, there's a certain requirement depending on the state. I believe it's 10 years. You're considered a legal spouse, regardless if you're legally married or not. So that means if you own real estate or have debts, they are one household's debt or asset, meaning that your spouse's debt is your debt and your spouse's property is your property. Moving on. Okay, we're going to put the address information. Let's say this is a first-time home buyer that's renting. They've been there for 3 years. We always want to put 2 years of resident history, of address history. So keep that in mind. You always want to put 2 years. Fannie Mae always asks for 2 years. Freddie Mac sometimes you could get away with 1 year, but regardless, you need a 2-year history when it comes to the address. We're going to put the amount of rent, mailing address, same as the living address. Now we're going to go to the employment section. Primary, we're going to put Okay. We're going to put the address and the position of where the borrower works. We'd also want to put their phone number, the employer phone number. You want to help your processor and put the phone number of the person who can verify employment. So if it's a big corporation, usually they have an HR, human resource department. Sometimes if it's a smaller owner-operator business that has a handful of employees, it might just be the owner versus his office number. So make sure you put the phone number of the person who can verify employment. Go ahead and make sure you also put 2 years of employment history. Super important to have 2 years of employment history. Why? Because Fannie Mae and Freddie Mac ask for those 2 years of employment history. I know that if you're self-employed, Freddie Mac likes to see a 5-year history to confirm that you're the owner of the business. So just mentioning that to you. Okay. Rule of thumb is you want to keep your debt to income ratios at 45%. So always educate my borrowers and telling them that you're going to qualify for a mortgage payment that's 45% of your income. Basically, why? Because you have your housing debt to income ratio, which is your front end ratio. That means that in essence, what you have is you have okay, I thought I lost my mic. So your debt to income ratio, it means your mortgage payment divided by your income. And your total mortgage payment that you qualify for cannot exceed a total of 45% for conventional loans. Sometimes you can get away with 50%. And in other cases, for an FHA loan, you can get away with 47% of a front-end debt-to-income ratio. What is the back-end ratio? It means your total mortgage payment plus your debts divided by your income. That debt-to-income ratio for a FHA loan cannot exceed 57%, and for a conventional loan, it usually caps out at 50%. Okay? Let's see. Here on the next section, which is going to be page 2 and 3, you're going to start off with the borrower's assets on the top. You always want to make sure you put asset information in here. Why? Because if you're purchasing and you export this Calyx Point file, you're going to need assets when you run a DU or an LP. So let's put some assets in here. Chase Bank. Okay. You don't need to put the address. Next, we're going to request credit. We have to save it first. So once you save the file, you save it with the appropriate name. I like to put last name, comma, first name, then middle name, because this is just easier to keep track of the borrowers that way. And the last name, loan officers know that that's what we use. A lot of agents, what they use is the property address. When we request credit, you're going to have to input your credentials from your credit company. We currently have Cactus as a credit provider. I believe they used to be CoreLogic, if I'm not mistaken, or Credit One. Anyhow, that's our credit provider. Next, we're going to go to other liabilities. This is in the event that the person has, let's say, child support, alimony, or child care. This is assigned by the court only. This is not voluntary. So you want to make sure that this is also put in there. We're going to put some debts in here just so that we can see a quick scenario. This is going to be another one. And then And let's say it's going to be $3,000. We're going to do a rate and term here in this situation. So I jumped down to the section of 3A, which is property you own. So here's where we would put the Schedule E, or the schedule of real estate. I'm putting that information here now. Property value, the status, sold, pending sale, or retained. It's going to be retained. Intended occupancy primary, current occupancy primary, taxes and insurance, if they're included in the mortgage payment, you leave that blank, or you could put I&C included. Rental income 0. Now, how do you match this with the liability in the mortgage? What you want to do is click match with liability. You find your mortgage, you make sure it's set with your property. If you have other mortgages, you're going to see them here. And if you have other properties, you'll see them here and you'll match accordingly. If the property is free and clear, you would not have to do anything in this case. So we'll match it. And then when you open this up again, you would see that the mortgage payment is down below. Now we're going to page 4. You can go to page 4 on the left section here, or on the bottom, just go ahead and click page 4. Subject address, copy from present address. This is a quick import tip. Number of units 1, year built, 1990. We're going to move on to, if there's any gifts, we would put them in 4D, FHA loans. In my area, see a lot of gifts. So this is where you would input those gifts from a family member or any relative. Rental income on the property you want to purchase. In this case, you would put the information on your Schedule E on your prospect information if this is going to be a true investment. Moving on to section 5, you have your declarations. The first one is normally yes, if you will be occupying the property as your primary residence. The rest of them are normally no. Go ahead and read through those questions on your own time. They ask questions such as if you're a co-signer for another note, if you declared bankruptcy in the last few years, if you've had a foreclosure in the last 7 years. These are some declarations if you have judgments against you and such. So check this out, read them thoroughly, make sure you ask your borrowers the questions if you're taking a application over the phone or if they emailed you the documentation. Next, we're going to page 7 and 8. Did the borrower serve in the military? This case is no. Race, white, male, Mexican is the ethnicity. So ask these questions. Don't guesstimate these questions. Normally, my applications are taken over the telephone, so I put telephone interview. For applicants taken in person, the NMLS does want you to give your opinion. What was the ethnicity of the borrower, was the ethnicity of the borrower collected on the basis of visual observation or surname? Was the sex of the borrower collected on the basis of visualization or surname? Why do they ask these questions? I don't know why they want to keep track of all of this, but this is for face-to-face appointments or 1003 applications. Was the race of the borrower collected on the basis of a visual observation or surname? Again, I don't know why they ask these questions. Moving on to section 9, we have the loan officer information. David Rodriguez. We're gonna update this information now. Now we go to the prospect information where we qualify the individual. So moving down to the middle of the section, we have loan summary. What we want to do first is I skip these loan programs in CC scenario because you would have to integrate those into your system. A lot of companies already have them set up, but they're not needed. So straight off the bat, go from purchase to refinance because that's our scenario that we're going through. It's going to be a no cash out refinance. It's a conventional loan, a primary mortgage. The note rate, let's say that the market today, rates are horrible. As you know, they have gone up. We're in June 15 of 2022, going through rate hikes. So let's say it's a 5.5. We're going for a a 30-year mortgage, the appraised value is about $775. So the current mortgage is a balance of $350. Say taxes. Okay, so once I put this information here, the appraised value and the loan amount, what I want to do next is go down. On the left section, I have if this is what type of product this is, conventional, FHA, VA, USDA, or other. Then I have the type of living on the property, if it's primary, secondary investment, FHA secondary. Then if it's a first mortgage, second mortgage, third, fourth, or a HELOC. If it's an investment property, your rental income would reflect here. If it's a purchase only, if you are renting the property and you already own the property or the borrower already owns a property, you would put that rental income on your schedule of real estate over on page 2 and 3, down where section 3A is located, property you own. And it would automatically take it from there. On the bottom right, we're going to have the mortgage details where you can edit this and include information like homeowner's insurance, property taxes, mortgage insurance, or HOA. So we're going to do a quick scenario here for us. Say it's $45 a month. We're going to go to taxes. Taxes, let's say, are $450 a month. No mortgage insurance. So in this scenario, if this borrower is going to refinance his $350,000 mortgage at a 5.5 rate, let's say they're getting rid of mortgage insurance. The total payment's $2,482 compared to what they have. Go back to section 2 and look at the liabilities. They pay $2,850. So they're saving $368 per month. Now let's look at our debt to income ratios. On the right side, this tab, top and bottom, is going to show your front end ratios and your back end ratios. Your qualifying ratios for a conventional loan normally are 45 to 50% front end and back end. So this definitely meets that. Loan to value, it's a 45%. You can go up to 80%. And in some cases more for conventional loans. So this borrower also qualifies in that scenario. Anyhow, this is all great. One thing I did forget to mention is, how do you see the credit score, the middle credit score? When you pull credit on page 2, it'll automatically populate your FICO scores here where it says credit scores in the prospect information in the middle of the page. You would see the FICO score for Experian, TransUnion, and Equifax. Then manually, you're going to copy the middle score and put it into your minimum FICO. So that way, you know, going into the file what your borrower's middle credit score is. You want to then play with these ratios. If you're doing a purchase, you can increase the loan amount or increase the purchase price here in this prospect information section. Now that you have your liabilities included in the file and also your income included in the file. I will be posting an income calculation video, so stay tuned. I hope this is helpful. Go lock a lot of loans, guys. Thanks for tuning in.